Are you wondering how to build an investment portfolio? Don't know where to start? Confused about stocks, bonds, crypto, and all of the other asset classes? Today, we're talking about the core of your investment portfolio, what it is, what should you look for when building it, and why ETFs are a great way to create one. Your portfolio is the combination of all of your investments. If you're holding shares, cash, bonds, property, cryptocurrency, or a combination of these, they all make up your investment portfolio. Many investment strategies prescribe that a portfolio will have a core. This core is usually the part of your money that stays invested over the long term and makes up a larger portion of your portfolio. Whether markets go up, down, or sideways, the core of a portfolio is normally relied on to build wealth over the long term. Here's a parable that might be useful to help you understand. Two men were looking to build houses to live in. One of the men, the more foolish of the two, decided that it would be best to build his house on sand. When the rain and floods and wind came, the house fell. It had been built on shaky ground. The other man, the wiser of the two, decided that it would be best to build his house on the rock. When the rain and floods and wind came, the house stood firm. Its core foundations were strong. Just like the stable ground helped the wise man's house to weather the storms, a strong portfolio foundation can help investors to navigate market storms. Creating a strong core means a strong foundation for building wealth over the long term. If you're interested in learning more about how the core of your portfolio fits in with a broader investment strategy, you can check out Lesson 9 of our BetaShares Explains Investing course here. So now we've established what the aim of a core portfolio is, the question becomes, how do you build one? Here's a few key things you want to look out for when building your core. Conventional investment wisdom suggests that you create a diversified asset allocation. All this means is that you split your investment into different sources of return. Holding multiple assets like Australian shares, international shares, and bonds helps reduce the risk that poor performance in any single asset class will ruin your entire portfolio. When picking core investments, you can make sure it's diversified by checking how much exposure to different sectors are there in your portfolio's share allocation. A company that operates in the healthcare sector may perform differently to a company in the technology sector or banking sector. Having exposure to more than one sector in a portfolio means that, say, a banking crisis is less likely to result in a big loss for your overall portfolio, because the crisis might not have as much impact on the technology or healthcare companies that you hold. How many different asset classes are there in your portfolio? Bonds perform differently to shares, which will perform differently to property. Have a look at this graph. This is the performance of three indices that represent Australian shares, Australian property, and Australian bonds in the last 12 months. As you can see, these three distinct asset classes have provided different performance over the long term. For example, when share prices fall, it's not necessarily the case that bond prices also fall. Having different asset classes helps to ensure that even if one asset class performs poorly, this could be offset by better performance of another asset class in your portfolio. So you're less likely to suffer a large loss across your total portfolio. How many countries is your portfolio exposed to? Different countries carry different risks. So the more countries you hold in a portfolio, the more diversified your country risk is. This may mean holding some Australian investments combined with some investments in US companies, and even some investments in countries with developing or emerging markets. Keeping these three things in mind can help you create a better diversified core to help you build wealth over the long term. If you're enjoying this video, consider liking and subscribing for more educational investing content. And let us know in the comments if you have a topic you think we should cover next. Back to building the core of your investment portfolio. Next, you want the core of your portfolio to be low cost. Because the core often makes up the largest portion of your portfolio, you want it to be cost effective to invest in and maintain. This will help keep your total portfolio costs low. Management costs charged by fund managers and brokerage costs when you buy and sell all impact your final returns. When these costs are too high, it can eat away at your overall performance. All else held equal, the lower the management costs on your investments and the less frequently you have to trade them, the better. Finally, it's important that your core portfolio helps you sleep at night. Just like the man who built his house on sand would be tossing and turning in fear of a thunderstorm, an investor with a volatile portfolio core might struggle when market conditions get tough. Having a strong foundation means you don't have to worry about losing everything when markets go through downturns. For example, a core portfolio of cryptocurrency or speculative investments might sound good when these investments are performing well, but they can lead to sleepless nights if performance goes south. But a core portfolio of shares and bonds diversified across different industry sectors like banking, finance, technology, and healthcare, for example, can give you more peace of mind so that you can spend more time on other important things in your life, like where you're going for dinner or whether or not tickets to see your favorite artist have sold out. So, is there an easy way to get these three things in a single trade? Enter ETFs. ETFs are a collection of shares or bonds, or a combination of both, that are packaged up into an easy to trade and low cost investment. ETFs can provide diversification benefits and tend to be low cost, so they can be effective building blocks for an investment core. A mixture of ETFs across Australian equities, international equities, and fixed income can put you in good stead over the long term. For example, a broad-based ETF like A200 holds 200 companies listed on the ASX across different sectors. Blending that with something like BGBL, a global equity ETF, can provide a well-diversified, low-cost share portfolio. Alternatively, an all-in-one diversified ETF can roll these investments into a single ETF, which adds to the ease of investment and helps keep brokerage fees low. You can check out our broad range of ETFs on our website here. Each ETF clearly labels its holdings, country and sector allocation, and its management costs. So that's what a core portfolio is and how you can build it using ETFs. If you like this video, consider subscribing for more investing educational content, and we'll see you in the next one.